I think one of the things that we're looking to do is take a look at what we own that could potentially have a catalyst to buy here. So I think you already mentioned some of the names, travel and specifically whether it's cruise lines or airlines. Historically, all of those stocks have performed poorly when there's been an outbreak of this nature. The other thing we're looking at is just, industrials this week. I think it's important. We obviously have some notable tech stocks reporting earnings. If you look at the industrials, though, we've really seen a pause as far as this rotation from growth to value over the last couple of weeks. And I think that that's going to persist and could potentially be compounded if we have some disappointment in the industrial earnings this week. So I think, number one, there's some opportunity that exists in the market as far as some of these names. But number two, I think that we're looking for a little bit more support. My biggest concern with the coronavirus is that we were really looking at China and the reacceleration from an economic perspective as being a catalyst for this first part of the year and justifying some of the gains we've seen in the equity market. With that kind of coming to the fore, I'm a bit more concerned about the sentiment impact on Chinese growth rather than the virus itself.
All right, so Joe, I get it, right? The investment committee, if you will, is taking a look around, taking a look at your books. You're trying to see what looks attractive, what is maybe sold off too much. The problem is when to know when to buy if you're thinking about doing that. Mike Wilson, okay, over at Morgan Stanley says that the correction has begun. OK, we suspect the first correction since October has begun, but will be contained to 5% or less because of liquidity. He says index prices appear to be ahead of the fundamentals. And that's been a question all along in this run up. Is it matched by fundamentals or not?
So the market finally found its reason to correct itself. When I say the market, I want to focus specifically on the equity market because the credit markets are trading fine today. Municipal bonds are higher. Investment grade is higher. High yield is rightfully lower. It should be because of energy prices. So the equity market has found its reason. But this has been building over the last couple of weeks. We've been talking about it on the show. One of the reasons why it was not about Apple or Microsoft or Alphabet. It was the weak performance of financials. It was treasury yields that were rolling back towards 160. That's an uncomfortable level for financial institutions. With everyone exposed to financials, that left the market in a position that we could be facing what we have here today. So, yes, the right thing to do is to be looking for opportunities in the marketplace. Can we endure a further sell-off that takes us down 5%? Absolutely.
If not more, let's not forget it, right? Ebola took us down 10% on the S&P. It was a good for 200 points. 200-point sell-off.
If not more. But let me just say this. There are a couple of things that are going to happen because of this that I think longer term are favorable. Number one, the Federal Reserve, they're not going to be communicating anything that's going to disrupt the markets after what we've experienced here the last couple of days.
Right, so I'm going to check that off my list of worries.
Check that off your list. Fed's on your side. We don't have to worry about the Fed. We've got earnings that are coming up from the big technology names, okay?
Yep.
What are those earnings going to look like? The street expects them to be positive. What's the price action response going to be? Is it going to be like J.P. Morgan? Great earnings, price performance lousy? That might just be the case, and that's going to be the key to tell you how deep this correction is.
That's right, because, Jenny, you've got, according to Dubravko Lakos of J.P. Morgan, significant growth optimism's already priced into equities, and that means there's little risk. I mean, there's more risk now that a less than exceptional outlook from these companies now reporting, and you got a boatload of them this week that really matter. That could be a huge disappointment.
Right. So this is where I go when we're in a time of potential panic or something to actually finally panic about. This is where I go and I look exactly at the companies in my portfolio and what exactly I own. And this is what I encourage everyone to do, too, because it's a wonderful way to ground yourself. So I went through the portfolio, and I've got 36 companies in my dividend portfolio. 6 of them, I think, may have risk to slowing China growth or a problem out of China or coronavirus. There might be risk to 6 of them. That means 30 companies in my portfolio have no impact whatsoever because of this. And that's a nice way to give yourself a pause, take a step back, think about earnings, think about the fact that these earnings are based on 4Q numbers and that's probably going to be positive. And as 30 at least of the companies in my portfolio report, it's very unlikely that coronavirus or China GDP is even going to be mentioned in their earnings report. So I think the vast majority of companies broadly are not going to be addressing this in the earnings. And I think that we will get that chance to step back, move on, and look at the bigger picture.
One of the worries, Jim, was that, if you thought the market was ahead of itself, there are people who thought the market was overbought. All you needed was a little match to light something, and you could have this first correction in a while. Now, maybe it's coronavirus. Okay, that's what it appears to be today. Do not discount, though, I think, Bernie Sanders rising in the polls in these early states. It just becomes a cocktail of things that could potentially be upsetting for investors. Coronavirus means you had a little bit of a tip over. Now you're worried about Bernie, and you have just reason to sell and wait. Am I wrong?
You're right. I think the question that comes from that is how long to wait. I mean, Scott, I was trimming over the last couple of weeks, not raising gobs of cash, but about a 10% cash pile right now. I'm not rushing into the market right now. I mean, everything you're saying, and you left out, there's some rockets fired in Iraq at our compound there. So everything you're saying is sort of creating a brew here, but I can't even use the word correction here. We're 2.5% off the high. If we go down 5%, that to me is the normal noise of any given month that can happen.
Sure, but in the midst of being down, let's say we're down 2 something now, you go down 4. Yeah. Who's going to have the conviction to step in at that moment, because you're going to be thinking then that what if we're down 6?
I got to tell you.
What if we're down 8?
I got to tell you,
what if it goes down 10?
You and all of us here are in touch with a lot of investors, and most of us have been waiting for this, right? I mean, most of us have been saying, yeah, we're trimming, yeah, we think it's a little bit overbought, and we just need, you use that spark to bring it down, but that is an opportunity for us to actually put money to work. And I can look at, either specific names like a Disney. Obviously, they're closing Disney Shanghai. They have to right now. That will affect first quarter earnings, but it doesn't upset their long-term plan, whether it's their movies, whether it's the theme parks, or, of course, Disney Plus. You can look at Starbucks. Obviously, these things will be affected. Frankly, all earnings will be affected in the first quarter of this year. But what we've seen historically is that things like SARS, like MERS, like swine flu, like Ebola, they pass relatively quickly. It is highly unlikely that this passes through to the second quarter.